Hello everyone. Thank you for attending 2020 Rural Research Symposium. I welcome you all to our very last panel of day 2 of the symposium. I'm Jaya Day, Senior Economist at Client and Community Engagement Division at Freddie Mac and will serve as a discussant for this panel. Our panel today focuses on examining the attributes of borrowers and lending in rural areas. Let me quickly introduce you to the panelists for today. Kristen Wong from CFPB, Logan Herman from CFPB, Fang Liu from CFPB, Yang Zhou also from CFPB, and Rama Yanamandra from Freddie Mac. They all have very interesting research on a very relevant topic, so without wasting any further time, I would like to invite our first presenters, Kristen Wong and Logan Herman, to our virtual podium. Kristen is a financial analyst on the mortgage markets team at the CFPB. Her focus is on market monitoring, access to credit, and data analytics. Joining her will be Logan Herman, who is Director's Financial Analyst at the CFPB. His work focuses on data analytics, risk management, and consumer access to credit. Before they begin, I have a quick reminder for the audience. Please click on the Q&A icon to submit your question during the presentation. Kristen, please take it away.
All right. Thanks, Jaya. So to start off, my name is Kristen Wong, and I'm here with Logan Herman to discuss a market snapshot that we published in March of this year. So we wanted to just answer some basic questions about first-time homeowners, such as how many are there, who are they, where do they buy, and what do their mortgages look like? And then we also wanted to do a historical look back tracing affordability. So if you're making the transition from renting to owning, market shifts can play a large role in whether you can afford to buy. For example, unlike most repeat buyers, first-time buyers do not have the benefit of accumulated home equity. And additionally, they don't have an existing home that insulates them from rising housing costs. So given that we've had some pretty big shifts in the mortgage and housing markets in the past 15 years or so, we thought this would be pretty interesting to look at. And then we look at many different demographic groups. One of the groups of borrowers we particularly focused on was rural first-time borrowers. So that's why we're so excited to be here today. I'm going to start with talking about the data, and then Logan will talk about our findings. Before we get any further, I'll just do a short disclaimer. We are presenting on behalf of the CFPB, but any opinions or views that we state are our own and may not represent the Bureau's views. So I'll get into the data. We use the National Mortgage Database, also known as the NMDB, to conduct our analysis. The NMDB is a nationally representative 5% sample of all outstanding close-end, first lien, 1 to 4 family residential mortgages. The NMDB is jointly funded by FHFA and CFPB, and it has loan-level data on mortgage performance, mortgage terms, property characteristics, the type and purpose of the mortgage product, as well as credit-related information. For our analysis, we are specifically looking at consumers purchasing their first home between 2002 and 2018, and we solely analyze home purchasers buying a primary residence. And as you know, like how you define, first-time home buyers and rural makes a big difference as to what your results are going to be. So for our analysis, we define first-time home buyers as borrowers who appear to have no previous mortgage in the preceding 7 years. And so, some loans will have a mix of first-time and repeat borrowers. For loans with more than one borrower, our analysis only uses the borrower with the longest payment record. And so by analyzing only one borrower, the estimated number of first-time buyers in the snapshot will be slightly higher than measures that require both borrowers to be first-time buyers, and then slightly lower than measures that require only one borrower to be a first-time buyer. So in case you're looking at our numbers and that doesn't seem quite right to compare to something else you've seen, that might be one reason why. And then our analysis also differs from those that analyze cash sales along with finance purchases, as we are only focused on people who are using a mortgage to buy a home. And then finally, to define rural, we use the USDA 2013 Rural Urban Continuum Codes, and we define rural as the non-metropolitan counties in urbanist and metropolitan counties according to these codes. And so with that, I will turn it off to Logan, and he will talk about some of our findings.
Thanks, Kristen. So now I'll discuss the findings of our analysis and how we use NMDB data to learn more about the trends and characteristics of rural first-time homebuyers. So as you mentioned, a concern that's been expressed is affordability for first-time homebuyers and what that means for access to the market. So when we looked at the data, we found that about half of all home purchase mortgages have gone to first-time buyers each year since 2002. And while we have about 600,000 fewer mortgages that went to first-time buyers in 2018 than did in 2002, this is primarily a result of the overall decline in the purchase market during the financial crisis, and then that steady recovery since 2011. So we're seeing that first-time homebuyers have really maintained a consistent share of the market over the past couple of decades. So then we wanted to look at the shares of loans made to first-time homebuyers in rural and urban areas. So here we have a chart of originations to first-time homebuyers, and it's broken down by rural and urban borrowers along those continuum codes. And what we can see here is that, again, despite these changes in overall loan volume, rural borrowers have consistently accounted for 11 to 13% of first-time homebuyers. So we can see that rural borrowers have really been a very steady part of the housing market. And as we ran our analysis, we wanted to understand changes in the loan products used by first-time homebuyers. So first, we're going to look at trends in the types of loans originated to first-time homebuyers as a whole. And then the next slide, we'll look specifically at rural borrowers. So here you have loans originated to first-time homebuyers by type of loan. And what you can see is that after the financial crisis, first-time homebuyers initially migrate to loans insured by FHA. But as that market recovered, loans guaranteed by the GSEs became the most common choice for first-time homebuyers. And one driver of that could be the GSE's introduction of low down payment options in 2014, which made the GSEs more competitive for first-time borrowers, especially for those with higher credit scores. So then we wanted to see if that story is different for rural buyers. So here we have that similar chart. This one is for rural first-time home buyers. And here we can also see that shift away from private or portfolio loans. One thing we also found is that USDA loans have become an increasingly important source of credit for rural first-time borrowers. And that increased from 4% of rural first-time buyer loans in 2002 to 17% in 2018. And you can also see that in this chart, for a couple of years, USDA loans were the largest loan type for rural first-time home buyers. So between the early 2000s and 2018, we can see that originations for rural borrowers has moved away from being dominated by just GSE and private loans to being more split between GSE, private, FHA, and USDA loans. So next, we were interested in looking at the age of when first-time home buyers entered the market and how that differed by the cost of where they lived or by rural or urban area. So first, we have a chart of high-cost and low-cost MSAs, where we look at the median age of first-time home buyers between 2002 and 2018. So this upper row of the chart shows a few selected high-cost MSAs, and then that lower row shows the low-cost MSAs. And we find that borrowers in more costly MSAs tend to be older than buyers in more affordable areas. So in most of these MSAs, we see that the median age of first-time home buyers declines during the housing boom prior to the crisis. And then after that crisis, we see that many of these lower cost MSAs return to pre-housing boom levels. But for the higher cost MSAs, the age where first-time home buyers enter the market has continued to rise. And you can see that for many of these high-cost MSAs in California or with Miami, the median first-time homebuyer is entering the market often 5 years after borrowers in low-cost MSAs. You can also see that for some of these high-cost MSAs, such as LA or Miami or San Francisco, these can represent very large urban areas, where the more affordable MSAs, such as Dayton or Wichita, we might think of as being more rural adjacent. So then we wanted to compare the age at which urban and rural borrowers entered the housing market. So rural counties contain over 85% of what's known as older age counties, ones that have a significant percent of their population age 65 or older. And many of these counties have had this persistent population loss of young adults. So we wanted to see if this demographic shift was reflected in trends for first-time homebuyers. But in fact, what we see is that between 2002 and 2018, rural and urban borrowers enter the market at similar ages. And by 2018, the median rural first-time borrower was 2 years younger than the median urban borrower. Another trend we found is that prior to the financial crisis, rural borrowers tend to have a lower combined loan-to-value ratio than an urban borrower. However, since 2007, that gap has essentially disappeared. And we saw that this trend also coincides with changes in the composition of loans for rural first-time homebuyers, including that relative increase in the use of USDA and FHA loans that tend to have higher combined loan-to-value ratios. So that could be a driver there. Here we also look at debt-to-income ratios between urban and rural borrowers. So even though rural borrowers tend to have lower incomes in comparison to their urban counterparts, the median rural borrower had lower debt-to-income ratios over the past 15 years, which makes some intuitive sense as rural borrowers tend to have greater access to lower-cost housing. And finally, we looked at differences in the credit scores between rural and urban borrowers. So here we show the median Vantage scores between rural and urban first-time homebuyers. And here in this chart, what you can see is that prior to the housing boom, the median credit score of a first-time rural and urban buyer was essentially the same. But in the early 2000s, these scores diverged, and they've continued to grow apart. So you can see that as of 2018, the median credit score of an urban first-time homebuyer was 24 points higher than that of a rural first-time homebuyer. So in our analysis, we find that rural borrowers have maintained a consistent share of the first-time homebuyer origination since 2002. And since the financial crisis, rural first-time homebuyers have shifted away from originating private loans and are now more likely to borrow with GSE, FHA, or USDA programs. We also found that rural borrowers tend to have lower debt-to-income ratios and lower credit scores than their urban counterparts, and that the median rural borrower is also attaining homeownership slightly earlier in 2018 than they did in 2002. So as we continue to study the experience of rural homeowners, these buyer attributes and credit scores and geography really play a key role for when borrowers can enter the housing market. So with that, you can submit questions via the Q&A box. You can also find our complete market snapshot on consumerfinance.gov. And please also feel free to reach out to either myself or Kristen. And with that, I'll turn things back over.
Well, thank you so much, Kristen and Logan, for an excellent presentation. Next, I would like to invite Young Jo and Feng Liu. Young is an economist at the CFPB and consults relevant stakeholders on fair lending supervisory exams, advises policymakers on the economic consequences of proposed regulatory changes, and conducts research on housing and mortgage market. Joining her, we have Feng Liu, who is a senior economist at the CFPB, is a subject matter expert on compliance analytics, HMDA, and credit cards. Feng will participate during the Q&A session. As a reminder, please click on the Q&A icon to submit your questions for the presenters. Now over to you, Yang.
Okay, thank you very much for including our paper in this interesting symposium. This is a joint work with my colleague Feng Liu. We want to emphasize that the views expressed here is our own and not of CFPB. Let me go over a little roadmap of what we plan to present today. First, we're going to talk a little bit about the HMDA background information. Next, we'll move on to the characteristics of lenders in rural areas. And then we'll discuss a little bit about characteristics of mortgage borrowers in rural markets. And we'll conclude with the characteristics of mortgages in rural areas. I want to point out that all of the analysis that we present here today is using the HMDA 2019 data. So let me give you a brief background of the Home Mortgage Disclosure Act, or what is known as HMDA. HMDA is a data collection, reporting, and disclosure statute that was enacted in 1975. HMDA data are used to assist in three different purposes. First is to determine whether financial institutions are serving the housing needs of their local communities. Second is to facilitate public entities' distribution of funds to local communities to attract private investment. And third is to help identify possible discriminatory lending patterns. Institutions that are covered by HMDA are required to annually collect and report specific information regarding mortgages acted upon and purchased during the previous calendar year. The Dodd-Frank Act amended HMDA to require reporting of 13 new data points. Also, in the 2015 HMDA rule, which amended Reg C to include 14 additional data points, also revised several pre-existing data points and changed coverage requirements. So starting with the data collected in 2018 and reported in 2019, the HMDA data look significantly different from the data in previous years. If you're interested in learning more about the HMDA data or the related rules, please visit CFPB website linked here. So the coverage of HMDA in rural area is limited, and there are two reasons for this. The first is that small financial institutions with small origination volume do not have to report to HMDA. The second reason is a location test. So basically, if your financial institutions exclusively operating in rural area, then you don't have to report to HMDA. So because of these two reasons, we believe that the coverage of HMDA in rural area is limited, and this is something that we continue to investigate. As Christine has mentioned, the definition of rural can vary depending on which categorizations that you use. In our case, we also use the 2013 Rural-Urban Continuum Code to define urban versus rural. This code varies between 1 being the most metro to 9 being the most rural. And we use this code to define areas into 3 categories: metro, rural, and completely rural areas. In our presentation, we only focus on the comparison between metro and completely rural areas, because the characteristics of rural and completely rurals are quite similar. So for time simplicity's sake, we are only going to focus on the comparison between metro and completely rural areas. Let's move on to looking at the characteristics of the lenders. If you look at the top 10 lenders in metro areas, you recognize a lot of familiar names, such as Wells Fargo, Quicken Loans, JP Morgan Chase. Next, when you look at the top 10 lenders in completely rural areas, you see that a lot of the names are pretty much an overlap from the metro areas. The two most notable differences are the 21st Mortgage Corporation and Vanderbilt Mortgage and Finance, which are the companies that specialize in manufactured housing loans. Moving on to the characteristics of rural borrowers. We found that the rural borrowers tend to be slightly older than the borrowers in metro areas. For example, the average age of the metro borrowers is 46 years old, compared to 48 years old in completely rural areas. Also, the rural borrowers are less likely to be Black, Hispanic, or Asian. For example, in this table where we look at the share of borrowers belonging to different racial groups, you can see that the share of Black borrowers in metro areas, highlighted in blue, is 7.4%, compared to that in completely rural areas, highlighted in red, which is 2.3%. And that is about 5.1 percentage points lower in completely rural areas. Rural borrowers also tend to have a lower credit scores. The average credit score of metro borrowers is 733, and that in completely rural area is 727. You can also see that in this graph where you plot the credit scores on y-axis and the percentile of credit scores in x-axis. The blue line represents the metro area borrowers, and the orange line represents rural, and the gray line represents a completely rural borrower. As you can see, the blue line is always higher than orange or gray line, showing that the borrowers in metro areas have a higher credit scores than borrowers in rural or completely rural areas. Rural borrowers also have a lower income than metro borrowers. The median income of metro borrowers in HMDA data is $91,000, compared to $71,000 in completely rural area. Interestingly, even though rural borrowers have a lower income, they also have slightly lower debt-to-income ratio, or DTI. As you can see here, the average DTI of metro borrowers is 36%, compared to that of completely rural borrowers at 35%. Rural borrowers and metro borrowers have similar combined loan-to-value ratio at 79%, as you can see in this graph where the lines more or less overlap throughout. One interesting finding is that the rural borrowers are more likely to be denied. Here we look at the share of borrowers that are denied by the different geographic areas. And you can see that the share of metro borrowers that are denied is 15.2% compared to 20.9% in completely rural areas, which is about 5.7 percentage points higher. In order to investigate this further, we conduct a simple linear regression with rural and completely rural as a dummy variables. In the first model, we don't control for any factors, whereas in the second model, we control for applicant borrower and property characteristics such as credit score, CLTV, DTI. And then third most comprehensive model that we have, we control for all the factors in model 2. And in addition to that, we control for loan characteristics, such as loan types, loan purpose, and so on. The reason why we control for these factors is because some of the differences in denial rate between rural and metro borrowers may be driven by these borrower or property characteristics. So by controlling for these factors, we want to see how much of those can explain the discrepancy in denial area and see how much of the discrepancy still remains after controlling for these factors. As you can see in model 3, which is the most comprehensive model that we have, after controlling for all these characteristics, there still remains a discrepancy in denial rate between metro and completely rural borrowers. Here we can see that completely rural borrowers are still denied at 2.5 percentage points higher than borrowers in metro areas. Moving on to the characteristics of mortgages. Mortgages in completely rural areas are more likely to be conventional conforming loan or RHS FSA loans, which are USDA loans. And they're less likely to be conventional jumbo or FHA loans. We also find that the mortgages in rural areas have a lower loan amount. Here you can see that average loan amount in metro area is $292,000 compared to $188,000 in completely rural areas. And also the share of home purchase loan is slightly higher in rural area at 60% compared to 55% in metro area. On the other hand, the share of refinance loans is slightly lower at 38% compared to 43% in metro areas. Lastly, the share of first lien mortgages are similar across geographic areas at 96%. Another interesting finding is that the mortgages in rural areas have a slightly higher interest rate at 4.125 compared to the ones in metro areas at 4%. Mortgages in rural areas are less likely to be a 30-year term, more likely to be an adjustable rate mortgage ARM. Mortgages in rural areas have higher shares of balloon or interest-only payments, are much more likely to be secured by manufactured homes. And lastly, the total loan cost per thousand is higher in mortgages in rural areas compared to metro areas. You can see that in this graph where the orange and silver line is higher than the blue line. So to conclude, rural borrowers are denied at higher rates, pay higher interest rates, and also pay higher loan costs per thousand. We believe that some of this discrepancy can be driven by borrower or loan characteristics that we were not able to observe and control for in the model. So we plan to investigate this further in our future research. Thank you.
Wow, that was a lot of really good information. Thank you very much, Young. Our last but not the least presenter of the panel is Rama Yanamandra, who is a senior economist with the Economics and Housing Research Team at Freddie Mac. Rama is responsible for primary and secondary mortgage market analysis and research, macroeconomic analysis, and forecasting. And before she starts, I have another reminder. Please click on the Q&A icon to submit your questions for the presenters. Take it away, Rama.
Thanks, Jaya. Thanks for having me here today. So I'm going to be talking about the home purchases in rural areas. So we've done an analysis of the HMDA data. So, what are the questions that we've looked at? So our objective when we started looking at this was this renewed interest in mobility, especially with the ongoing pandemic. We've been hearing about how people are moving away from the dense city centers to the suburbs and the rural areas. So we wanted to investigate what was happening prior to the pandemic, and were we witnessing similar trends in this movement away from urban to the rural and suburbs. And we answered this question by looking at home purchases, and we've compared home purchases in rural areas versus the suburbs and the urban areas. And in doing so, we also addressed the following questions. We looked at where home purchases have increased the most over the last 10 years. Is it in the rural, urban, or suburbs? What are the characteristics of these rural borrowers? How have these characteristics changed over the last 10 years? And we also looked at a simple linear probability model to see how these characteristics influence the probability of purchasing a home in a rural area. So some of the characteristics, as the others have also mentioned here, Logan and Young, so we are very similar in terms of what we observe. So to go to the data, so we've looked at HMDA data and we've compared the 2010 and 2019 data. And our universe is the single family purchase, owner occupied, originated first lien mortgage loans. But to define the urban, rural, and suburban areas, we've utilized a new HUD classification that just came out in June of this year. And it's based on an analysis done by Sean Buckles and Emily Molfino and Jet Polko. And it's called the Urbanization Perception Small Area Index. So what is the Urbanization Perceptions Small Area Index? So in the 2017 American Housing Survey, HUD and Census Bureau, they asked a question asking households how they perceive their neighborhood. So whether they think their neighborhood is urban, rural, or suburban. So they then use this data to build a model which identifies the characteristics of each of these areas to be urban, rural, or suburban. And then they picked up these regional and neighborhood characteristics, and then they applied it to all the ACS census tracts to define a census tract as rural, urban, or suburban. So what they found is that in their survey, they found that 27% of the households, they perceive their neighborhood to be urban, 52% perceive their neighborhood to be suburban, and 21% perceive their neighborhood to be rural. In terms of the variables that they've looked at, so they had 21 explanatory variables that they've identified, and I've listed a few here. So you can see population density, business density, employment, as well as race, ethnicity, age, and some of the structural characteristics of the houses. So what they found is that the density, whether it's population, housing, or business and employment, was 100 times more in the urban areas as compared to the rural areas, as you can see clearly here. And on the right hand here, I have the Washington, D.C. map and how people are perceiving their neighborhood. So the red here is the urban, which is the core DC. And then you have the rural areas out in Leesburg and Percival. And then we have the yellow, which is being perceived as the suburbs. So those are the suburbs. So what did we find? Since the UPSAI classification is also available at a census tract level, and we have the HMDA data also at census tract, we were able to merge these two data sets. So what did we find? We found that the home purchases in the rural areas were increasing even prior to the pandemic. So if you see this chart here, the urban purchases, home purchases declined 5%, and most of that increase is taking place in the rural areas, which increased by 3.3%, and suburbs increased slightly less at around 1.8%. Though if we look at the total purchases, suburbs still had a higher share at around 62% in 2019. So, but where is this shift taking place? So this is what distinguishes or is different about this classification as compared to what we've heard so far. So what they found is that even within the metro areas, there are some census tracts which people perceive to be rural. So this shift is actually taking place within the metros from the urban to the rural census tracts. As you can see here on the chart on the left here, so the increase of 3.3%, of that 3.3%, 2% of that increase is taking place within the metro areas. So the rural census tracts within the metro areas, they've increased 2%. And you see that the urban census tracts in metros have actually declined. So, so far we've heard urban areas, as being equated to metros, and non-metros to be equal to rural areas. But what this classification finds is that even within metro areas, we have certain census tracts which are perceived to be rural. But having said that, if we look at the distribution, we still have a larger share of the rural census tract within the non-metros, as you can see on the chart on the right here. So rural census tracts within the non-metros are around 70%, much higher as compared to the urban, as compared to the metro and the non-metro, and as compared to the metro and then micro areas. In terms of the states, so we're comparing 2010 to 2019, so we see what's happening over time, and we see the states in blue here are the ones which actually had an increase in the share of home purchases in rural areas. So it's Tennessee, Minnesota, Arizona, New Jersey, and California. And the states in green are the ones which have actually seen a decline in the rural share of total loans, and that's led by Arkansas, North Carolina, and Mississippi. The states in green are the ones which have actually seen a decline. And moving on to the demographic attributes, so some of these attributes were only available for the 2019 HAMDA and not for the 2010. So we do not 2010, sorry. So we do not have a comparison. But in terms of the age, we find that the borrowers in urban areas are skewed younger than in the rural areas. As you can see, the age, the dark blue line here, for the rural borrowers is higher than in the urban and the suburban areas. In terms of the gender of the primary borrower, what we notice is that the share of the female borrowers in rural areas is lower than in the urban and the suburban borrowers. And in fact, that share has gone down if you compare 2010 to 2019. So most of the female borrowers are actually making home purchases in the urban and the suburban areas. In terms of diversity, again, as others have also noticed, we found that the rural areas are less diverse than the urban and the suburban areas. But what we do see is that this diversity, there's an improvement. If you compare 2010 to 2019, the share of white borrowers has actually gone down from 86 to 78%, and the share of other race ethnicity groups has gone up in the rural areas between 2010 and 2019. And urban areas have been the most diverse among all three. In terms of the credit characteristics, we also see that the the LTVs are, the share of loans with LTV less than or equal to 80 is the lowest in the rural areas, and DTIs have been higher. The share of loans with DTI less than or equal to 43 is the highest in the rural areas. Again, this can go back to the purchase values. Purchase values have been the lowest in the rural areas. So given that there are a larger share of low-cost homes available in the rural areas. In terms of the median incomes and loan amounts, we find that the median incomes in the rural areas has been the lowest in 2019, but most of the increase actually took place in the median incomes in the urban areas between 2010 and 2019. In terms of the average, loan amounts, we find that the average loan amounts also increased the most in the urban areas between 2010 and 2019, but the rural areas had the lowest average loan amount between 2010 and whether it's in 2010 or 2019. Again, mortgage rates, we do find that the mortgage rates for loans in the rural areas have been higher than in the urban and the suburban. So what we did was we looked at similar loan characteristics, conventional 30-year LTV less than 80 and DTI less than 45. We see that on an average, borrowers in the rural area are paying 15 bips higher than in the urban areas. We also looked at what's happening to the site-built and manufactured homes, given that manufactured homes, we see more manufactured homes in the rural areas, and we see similar trends. So the interest rates that are being paid by rural borrowers are generally higher than the suburban and the urban borrowers. In terms of the loan types, we also see that the conventional loans have actually increased in all the three areas between 2010 and 2019. The share of FHA loans has gone down. Again, coming out of the financial crisis in 2008, given the credit constraints, most of the borrowers were leaning towards the FHA loans, and we had a very high share of FHA loans in 2010, but that's coming down now. FSA RHS loans are the highest in the rural areas, so the share of that has also come down even in the rural areas between 2010 and 2019. And VA loans also, we see that there's a higher share in the rural areas. So moving on to the linear probability model. So we looked at how these characteristics affect or influence the probability of making a home purchase in the rural area. So our dependent variable here is rural, 1, 0. And if we look at 2019, we find that a 1% increase in the income, it decreases the likelihood of purchasing a home in the rural area by around 1.6%. And as compared to the other non-Hispanic races, we find that the whites are more likely to make rural home purchases, while Blacks, Asians, and Hispanics are less likely to make rural home purchases. A manufactured home has more likelihood of being in a rural area as compared to the site-built homes. And as compared to the non-metros, we find that the metros and micropolitan areas have fewer rural home purchases. Again, given the shares that I was talking about earlier, we have a higher share of rural census tracts within the non-metros. And in terms of from a regional perspective, we see that a rural home purchase is more likely in the Northeast, Midwest, and South as compared to the West. So to conclude, we notice that this trend of movement away from the urban areas to the suburbs, and particularly to the rural areas, was prevalent even prior to the pandemic. Rural home purchases accounted for almost 1/5 of the total home purchases in 2019, and they actually experienced the most increase in total home purchases as compared to 2010. And we also find that there are differences in the borrower attributes between the urban and the rural borrowers. Rural borrowers are mostly 55 plus, again, mostly dominated by males. We have a large share of male borrowers in rural areas. Rural areas have shown less diversity, though we've seen that they are becoming more diverse as compared to 2010. The LTV has been the highest in rural areas and TTI has been the lowest. And interest rates paid by rural borrowers are higher than the urban and the suburban borrowers. So given the importance of this topic, we will continue to do more research on this. And again, if you have any questions, please click on the submit question icon and please submit your questions. Thank you.
Thank you, Rama. That was very insightful and quite an interesting way to look at rural. I thank all the presenters for their fabulous presentations. We are now going to transition to the discussion part of the session, and then we will open it up for Q&A. So if you have questions for the presenters, please make sure to submit them by clicking on the Q&A icon. All right. I want to begin by saying that this is a very relevant but understudied topic due to data limitations and lack of consensus on what is rural. Policymakers and practitioners have argued that mortgage borrowers in rural areas are potentially less well-served than other areas. Rural lenders have greater personal knowledge about their borrowers and local economic conditions, fewer assets, and smaller geographic markets. This could potentially constrain the supply of mortgages. I have put together a few slides to highlight some overarching findings. Let's begin with Kristen and Logan. So they use NMDB to study the loan and borrower characteristics of first-time home buyers. Can you guys hear me? Can you hear me? Okay, all right. Sorry. Yep. So, so Logan and so they use NMDB to study the loan and borrower characteristics of first-time home buyers. A unique feature of NMDB is that it is panel, so it allows one to identify first-time home buyers, unlike other widely used mortgage database like HMDA. Further, they define rural by using RUCC code. Some of their findings are that rural first-time home buyers are around 11 to 13% of the total first-time home buyers. Rural compared to urban first-time home buyers, rural first-time home buyers are more likely to be USDA, private label securities, similar in ages and have similar CLTV, and are more likely to lower median debt to income and lower median credit scores. By sizing the first-time home buyer, the rural first-time home buyers, and highlighting their characteristics, I think they make an important contribution. But it just leaves me wanting to know more. For example, I was wondering if they were able to slice and dice the data by race and ethnicity. I was also wondering if they broke down rural first-time home buyers by property types. Based on my own research, manufactured housing are less likely to be prevalent amongst rural first-time home buyers in NMDB. I wonder how might that influence their results. Next, I want to move on to Young and Fong's presentation. So they looked into similar topic, but using more commonly used dataset HMDA 2019 with a nuanced difference that they are using the non-public HMDA that CFPB owns. As a result, they can analyze many more mortgage and borrower characteristics than what's there in the public HMDA, thus making an important contribution. So they also use RUCC code to define metro, rural, and completely rural. And a lot of the findings are pretty similar to Kristen and Logan, even though they are using different data sets. So for example, their completely rural borrowers are more likely to be older, less diverse, with lower income and lower debt to income, have lower credit scores, and are more likely to be denied of mortgages. I do have a few questions, especially around the higher denial rate of rural borrowers. For example, what explains high denial rates for most in rural areas? Is it insufficient credit histories or something else? Second, even after controlling for loan and borrower characteristics, they find completely rural borrowers are more likely to be denied. Could it be due to disparities in wealth and reserves between metro and completely rural borrowers, which is not captured in the data? Finally, did they control for geographic variables, since there's a lot of heterogeneity even within rural areas? Furthermore, it would be helpful if they can split the conventional conforming loans in completely rural areas into GSE versus retail and private securities to see which entities have better presence in the rural market. My last comment to them is they found rural borrowers have higher interest rates. Typically, best rates are offered to borrowers with higher credit scores, and they found rural borrowers have lower credit scores. So I wonder to what extent the higher mortgage rate in rural counties explain their loan and is explained by their loan and borrower characteristics such as credit scores. And then my last discussion is for my last presenter, Rama, who had a very unique perspective on rural. She used urban, suburban, and rural classification based on the UPSAI index, which is at the tract level. And it's based on how consumers perceive their neighborhood. So there can be urban, suburban, and rural tracts within a metro as well as a non-metro based on perception. So she analyzes the trends in home purchases and characteristics of rural borrowers using the public HMDA 2010 and 2019. And despite using a lot of similar findings as the previous presenters, which is very encouraging. So for example, she found borrowers in rural areas are likely to be younger, a younger male, less diverse, and lower income. They have higher loan to value, lower debt to DTI, and lower loan amount, and have higher interest rate. I think our approach will be very helpful to study the impact of COVID-19 on people's migration patterns. There has been some evidence that home buyers are fleeing to metro post-pandemic to rural areas. But are they moving to areas they perceive as suburbs or rural? And how sustainable is that? One trade-off of this approach is that perception might change. So it could be challenging to study trends over long time span. I have two questions for her. We know rural does not have a great representation in HMDA. So based on her approach, what is the coverage of the rural tracts? That is, what percentage of rural tracts did not find a match in HMDA? Second, I think it will be helpful to further break down conventional loans in rural in 2010 and 2019 to further understand which entity gained the penetration in rural areas over time. So that was my 2 cents. I would let the presenters take a minute or two to respond to my questions before I take questions from the audience. So let's start with Kristen and Logan.
Thanks, Jia, for those questions. They're really interesting, and I think will definitely add to kind of the general information that people will get from our presentation. So first, talking about race and ethnicity of rural first-time home buyers. In our snapshot, we did not segment rural first-time buyers into any other demographic groups. However, we did look into differences across race and ethnicity for all first-time home buyers. And we found that since 2002, the median age of first-time homeownership has been the lowest for non-Hispanic white borrowers and the highest for Black borrowers. And the gap between these two groups has grown over time. So in 2002, the median Black first-time borrower was 2 years older than the median white borrower. And then in 2018, this gap was 6 years. And we noticed that this gap really started to grow during the financial crisis and has persisted ever since. Yesterday, Professor Logan shared how rural Black communities in the South were particularly hard hit by the COVID pandemic. So there's definitely a risk that this gap will grow, and particularly so in rural communities. And then as to your question about property types, that's a really important caveat to bring up. So buyers of manufactured homes can either get a traditional mortgage loan or a chattel loan, where a chattel loan is a personal property loan. And the NMDB data generally does not include chattel loans, so it will contain less data on first-time buyers of manufactured homes. Generally, we know that chattel loans have higher interest rates than traditional mortgages, and home buyers using chattel loans are more likely to have lower incomes. So in our charts, this, it might increase the median CLTV and DTI of rural borrowers if we had included them. However, on the other hand, borrowers using chattel loans are more likely to take out smaller loans. So this would work in the opposite direction and may cancel out the effects of their, incomes and interest rates. And then one last thing that I just want to something to look out for. The CFPB is currently working on an interesting research paper on manufactured housing that will take advantage of new data in HMDA that is specific to manufactured homes. So I just encourage everyone to keep an eye out for that.
All right, so next I'll turn over to Young and Fang to respond to my comments.
Thanks for the question. I'll answer the first question. It was the denial rate. So we observed the higher denial rate in the rural area. That's a fact, what we call a Stallers fact. The question is what leads to this Stallers fact. So in our preliminary work, what we presented here, right, we saw the rural area compared to the metro area, the rural denial rate is a 2.7 percentage point higher. And for the complete rural area relative to the metro area, the rural denial rate is 5.7 percentage point higher. And when we try to include the factor we can control in the HMDA, right, we're able to shrink that the disparity to much smaller scale, right? For the rural areas, and that gets to about 0.7 percentage point and almost close to zero. And for the complete rural, that we shrink to 2.7 percentage point, but still not at zero yet. So we can and we will continue that think of as academic exercise, how to best model the denial and explain the difference between rural and urban in that way. But I think the bigger question there is that the ways, right, as academic exercise, you can explain everything away eventually if you include enough things in the end. But that does not really prevent this, the value of this, the disparity is not real. Right? It's just like still there's a difference there, the social costs or the gap between the rural and urban areas. So it's a fundamental question as a policy or research perspective, including the Freedom Mac. I'm sure you're spending a lot of effort trying to address the issue of how to narrow that gap. And by looking at that, it's really to looking at the underlying factor, which even though can be used as explanatory variable, but what's really difference in those explanatory variables, particularly different groups there. So given that, so this is something we didn't put in the slides, but Yang and I have been doing some of the preliminary work on this, and in terms of looking at what they explain the denial in the HMDA. So there's three factors that we can observe in the HMDA that's really the most important factor leading to the denial decision. In the order is basically the most important one, actually the DTI, followed by the credit score and followed by the loan purpose, and then remotely followed by the CLTV. So that is actually, that relationship, that ranking order does not vary between the rural area and the metropolitan area when we separate the analysis by different areas. Yeah. But what we see is the relative importance of DTI in explaining the denial outcome. kind of drop when we move from the metropolitan area to metro areas, not from the metro area to rural areas. So DTI is not as important as the metro area. So relatively speaking, you can see maybe credit score matter more relatively speaking or in the relative term. And this is kind of confirmed by the fact that we see the DTI in the rural area actually is relatively lower compared to the urban area to begin with. So that is just a suggestive evidence, not conclusive evidence to say these are the things that really are contributing more to that higher denial rate we observe in the urban area. So that's just quick preview, and hopefully now we'll keep working on that and get more of the detail. We'll start now, so maybe coming back next year. For the interest rate, right, so that is actually a much harder question to answer in terms of, because when talking about interest rate, right, mortgage pricing is complex, highly complex in the sense that not only the mortgage interest rate, people pay over what they expect a lifetime loan. There are also the upfront costs, they have the trade-off, and where there's borrower choice or the lender choice, etc. there. And so it's very hard to explain the single equation, right? Single equation, the regression, putting an interest rate and then control for others, and may not be the most sufficient thing to address that question. In this new HAMNA data, which we have access to, right? So it is really, there's a component factor like discount point, there's a factor like lender credit, which is also the thing we're planning to explore in the next stage of research. Besides the interest rate, I do also want to point that back to one thing is that we do also observe the total loan cost. Total loan cost divided by loan amount, that also the higher in the rural area. So it's more like there's more complex picture beyond what we can observe in the interest rate. Hope that answers some of the questions.
Thank you, Fang. That was very helpful. Let's now move on to Rama, if you would want to respond to some of my questions.
Sure, Jaya, and thank you so much for your comments. And I completely agree that using this new classification, we're able to get similar results like the others. So that's definitely encouraging. So I think your first question was the coverage. So again, because, with this perception, we have rural census tracts even within the metro area. So what we do find is that the coverage is actually very good. It's actually 99%. So that was something, I think, again, because of this particular classification that we've used, it's really, really good because, the match, we have more coverage under the metro area. So we are able to get a higher share of those rural census tracts within the metro. So the coverage was 99%. So that was very positive. And in terms of the share of GSEs and I think you said private security. So what I haven't done a detailed analysis on that, but what I found is that the share of GSEs has actually gone up if you compare 2010 to 2019. So I think it's increased from around 32% to around 40%. And I also saw that the retained portfolio has gone down from 42 to 32%. So private securities have remained at approximately the same level. So hope that answers your questions.
Yes, that definitely answers my question. Thank you so much, Rama. I think we have time for one question from the audience, and then we will end the session. So let me take this question. With respect to higher interest rates in rural areas, does this continue to be the case when adjusting for loan size or when adjusting for origination channel, that is retail origination versus loans originated by mortgage brokers or correspondent lenders? So who wants to take that question?
I can take it and then maybe the others.
Okay.
So I haven't adjusted for the loan size, but if you see in my analysis, so if I look at conventional, the similar loan type, conventional 30-year, LTV less than 80 and DTI less than 43, we found that the interest rates in the rural areas were higher. I haven't adjusted for the loan size though, but that's interesting. I can look at that. But for other similar characteristics, we do see that the interest rates have been higher in the rural areas.
Thank you, Rama. I think we are towards the end of the session. So if we don't get to your questions today, we will follow up after the conference for a response. Thank you again to today's speakers. As a reminder, session recordings will be made available at the end of the conference. The deck for this session will be posted in the Resource Center. Your opinion matters. Please take a moment to complete the survey for this session. And one last thing, we will be beginning our networking lounge sessions in 15 minutes. And I'll be hosting the session on rural homeowners and loan attributes along with our guest speaker, Dr. Emily Warnell. Please drop by in our session if you would like to interact with her and hear about her research as well as her book. Thank you for joining and have a great day.